I just got back from ICSC Las Vegas 2026. Tens of thousands of people in one convention center. Every major retailer and player in retail real estate were there. And the mood on the floor, I would say, was quite bullish. While that conference was happening, which opened again this past Monday, the bond market was telling a very different story in the background. The 30-year treasury hit 5.13%, a one-year high. In the 10-year, 4.61%. All of these events happened in the same week, and how strip center owners reconcile them is the single important question that we're going to be talking about right now. I'm Ray Kang, and this is your Retail Weekend Wrap-Up. So ICSC Las Vegas. The conference floor felt a little light, a little bit different this year, but the real energy was on leasing. Capital is still strong. Retail is continuing its push forward, and you could hear great year come up over and over again in conversations with leasing teams and private landlords alike. But almost every confidence statement came from a quiet caveat behind it. That's the part we want to share with you today. In meeting after meeting, the same gap kind of kept showing up. Leasing momentum is real, but NOI hasn't caught up yet to reflect it. Brokers I sat down with were pretty upbeat about deal volume and asking rent traction, but the same brokers, when the topic shifted to underwriting, talked about higher concession packages, longer free rent periods, and tenant build-out costs eating into what looks like a strong headline lease number. Tenant remix was the working obsession. Almost every landlord conversation came back to the same question: what categories belong in our centers now, and which ones are quietly becoming riskier? The answers were converging. The categories getting underwritten with confidence right now are value-priced grocery, discount in dollar, service uses like medical and fitness and pet, experiential and entertainment, and quick service restaurants. The categories getting harder to underwrite are mid-tier apparel, casual dining beyond the QSR tier, and anything that requires discretionary spending without strong value positioning. Our Texas metro conversations were quite active, coming alongside other national locations such as Phoenix, Nashville, the Carolinas, as the places where institutional capital wants to deploy when they can finally get comfortable with the cost of capital. Several lender contacts I caught up with confirmed they're still active in well-tenanted strip centers in our footprint, but they were also clear the rate environment is gating the issue. The other theme I picked up was, of course, inflation. It wasn't on most of the formal panels in those exact words, but it kept surfacing in side conversations. Operators were talking about insurance costs, cab reconciliations, tenants pushing back on pass-throughs, and the consumer doing more frequent trips at lower basket sizes. And the last one matters because it can change how leasing teams think about co-tenancy and merchandising in ways the headline leasing number doesn't capture. Entertainment was the surprise sleeper. Trampoline parks, food halls, family entertainment concepts, fitness. The operators in those categories were among the most active on the floor. Anchored centers with the right physical layout, higher ceilings, large boxes, abundant parking are getting underwritten differently now than they were even 18 months ago. And of course, there was AI. Every other panel, every other booth, we had a major floor just dedicated to prop tech. Everyone's talking about what the new technology is. CCIM leadership made the point well during the week. The industry is in what they called the Friendster era before MySpace. So lots of tools, lots of pitches. Still, very few of them solving actual operational problems yet for private owners and also brokers and others in the industry alike. Now let's pivot to what was happening outside of the conference. The 10-year treasury closed at 4.61% on May 18th, a one-year high and the highest level since February 2025. The 30-year touched 5.13% the same day, almost near a one-year peak. By Friday, both had eased slightly. The 10-year landed at 4.55%, helped by oil prices coming off their week's highs and conflicting signals on the U.S. and Iran negotiations. But the more important number this week wasn't the closing level. It was what the long end of the curve is telling us. Markets are no longer pricing rate cuts in 2026. Futures are now pricing roughly a 40% probability of a 25 basis point rate hike in December. And that's a major shift. 6 months ago, the consensus expected the Fed to cut 3 to 4 times in 2026. The market is now telling us the next move could go the other way. Treasury Secretary Bessent spent the week at the G7 meetings in Paris fielding questions from European central bankers about U.S. debt sustainability and inflation. In plain language, the 30-year Treasury isn't directly your loan base rate will strip center acquisition financing prices off the 10-year Treasury plus a lender spreads. When your lender quotes a 6.5% or 7% rate, the 10-year is the foundation under that quote. The 30-year sits over to the side, but it isn't irrelevant. It's the signal about something economists call term premium, the extra yield investors demand to hold long duration paper instead of rolling shorter bonds. When the 30-year sits at 5% or higher, it's telling us bond investors are worried about 3 things: long-run inflation expectations, U.S. fiscal sustainability, and the risk that today's rate environment doesn't normalize back. Now, that worry shows up in commercial real estate in a couple of ways, and possibly over the next 6 to 12 months. First, it puts a floor under long hold capital's required returns. Insurance companies, pension funds, large institutions allocate against the long bond. When the long bond stays elevated, their required yield on long duration real estate stays elevated too. That bleeds into how institutional buyers will underwrite and ultimately into pricing for the kind of trophy strip centers being bid by REITs and institutional capital. Second, it shapes lender behavior on refinances. CMBS, life companies, and bank balance sheet lenders all watch the long end of the curve when they think about credit risk in a higher for longer scenario. And so they tighten their DSCR requirements, demand stronger sponsors, and price more conservatively on assets with near-term lease expirations. We've seen this play out on several refinances in our market over the past, say, 3 months. So if you're sitting on a center with debt maturing in 2026 and 2027, the rate math is now harder than it was 30 days ago. The deal that pencils at 6.75% all in doesn't pencil at 7.25%. The difference between those two rates on a typical 75 or 70% LTV strip center loan is hundreds of basis points of DSCR cushion and several $100,000 a year in additional debt service on a, say, a $5 to $10 million loan. So run the numbers now, not later. If the refinance is more than 12 months out, model both the rate path the market is pricing today and a scenario where the 10-year stabilizes 20 to 50 basis points higher than current. So knowing which side of that line your DSCR sits on before you need to make big decisions. Now, the conference floor was bullish on leasing, but the pump told a different story to most Americans this week. AAA put the national average for regular at $4.55 on May 22nd, and that was a 4-year Memorial Day high, $1.38 above where it sat at the same point last year. Texas came in at $4.09, the 5th cheapest state in the country, but still up roughly $1.30 from where it started this year. 6 states posted averages above $5. California crossed $6. Now that's the part of the equation the conference couldn't fully discount. ICSC was talking about the strength of the leasing pipeline. The consumer driving past the strip center on the way home from work was thinking about whether to fill the tank halfway. And the competition for that consumer's trip got more serious this week. Amazon went live on May 12th with Amazon Now, its 30-minute grocery and household essentials delivery service. The service is now widely available in DFW with active rollout in Austin and Houston. Prime members pay $3.99 per order. 3 of our state's largest metros are now in scope, and Austin and Houston are direct neighbors to the markets we work in every day. For grocery-anchored strip center owners, this isn't an existential threat. Most grocery trips will still happen in person, especially the weekly stock-up trip, but Amazon Now goes straight at the fill-in trip, the quart of milk, the missing onion, the last-minute essential. That's the trip that drives ancillary visits to the nail salon, the dry cleaner, the coffee shop, and the QSR pad at your center. Lose enough fill-in trips, and you lose meaningful sales for the inline tenants who underwrite their leases off foot traffic and not basket size. The Q1 2026 e-commerce data from the U.S. Census Bureau released this past Monday put retail e-commerce at $326.7 billion for the quarter, up 2.7% sequentially. The line keeps grinding higher even when the rest of retail sales soften. So a couple things to take away from this past week. One, the leasing strength is real, and so is the bond market's reset. Both are true. The strip center industry just spent 3 days celebrating the strongest leasing environment in a decade, while the long bond hit a one-year high in the same building. Don't pick one signal and ignore the other. The owners who do well in the next 12 months will be the ones who lean into the leasing tailwind on operations while underwriting the cost of capital headwind on any refinance or disposition decision. Second, tenant mix is no longer optional. The category is getting underwritten with confidence. Necessity grocery, discount and dollar, services, QSR, entertainment are pulling further away from the categories that aren't. If your center has more than 20% of its rent roll in tenants whose value proposition can't survive a $4.55 a gallon and an Amazon Now delivery in 30 minutes, that's the conversation to have this quarter, not next year, but now. So pull out your rent roll, check every tenant, flag the category that sits in the getting harder to underwrite bucket, cross-reference lease expirations against your refinance maturity. Stress test your refinance math at 25 to 50 basis points above today's quote and identify those tenants that will be affected by that fill-in trip. The QSR, nail salon, dry cleaner, coffee, and service users that depend on the grocery anchor or co-tenancy traffic. Thanks for joining me again. If you want to walk through your center's positioning, feel free to reach out. My contact information is below, and I hope you have a great week, and we'll see you next time.